Good afternoon, everyone. For those who are jumping on the line, I can see the numbers slowly building up. They usually start to peak at about 12:02, so we'll get going in just in a couple of minutes when a few more people have jumped on the line. All right, look, we have a lot to get through today, so in the interest of time, I'm going to kick it off. First of all, love to welcome those who are joining us on the line today, whether you are a new attendee of the Hewison Private Wealth Lunchtime is Money webinar series or a returning attendee. Thanks very much for joining us in what's been a really successful webinar series. We're in week 6, and I believe we've got a really valuable session ahead of us. And with that, I'd like to welcome Mark Freeman and Geoff Driver from Australian Foundation Investment Company. Thank you very much for joining us today, gentlemen.
Pleasure.
So as the introduction or as the invitation suggests, today I'm going to be having a conversation with Mark and Geoff from Australian Foundation Investment Company, an AFIC as we call them. AFIC is the largest listed investment company in Australia, managing a portfolio of Australian equities since 1928, if I'm not mistaken. So an incredibly long track record. They're managing around about $7.3 billion in assets within the portfolio. The primary objective of AFIC, not ASIC, that's a slip of the tongue, isn't it? Of AFIC, the primary investment goal is to provide shareholders with an attractive capital growth over the long term and to pay dividends, which over the time grow faster than the rate of inflation. So just introducing Mark. Mark, you're the Managing Director of AFIC, along with the 3 smaller listed investment companies, Djerriwarrh Investments, Mirrabooka Investments, and AMCIL Limited. You were a partner of Goldman Sachs back in 2001 and joined AFIC in 2007 of all 4 investment companies as the Chief Investment Officer, and you were appointed as the Managing Director of the companies in 2018. So it's great to have you on the line today, Mark. Thank you. And Geoff Driver, having begun at AFIC in 2003, Geoff is the General Manager of Business Development and Investor Relations, along with Djerriwarrh, Mirrabooka and AMCIL. And both gentlemen, as I understand it, sit on the investment committee of AFIC. So we certainly have the right people on the line today for our discussion. And look, just as a brief backdrop in relation to Hewison Private Wealth and our relationship with AFIC, the only relationship we have with AFIC is that we are we recommend AFIC to our clients. AFIC has sat on our recommended list almost since day dot 35 years ago. And essentially, why we do really like AFIC as an investment. To begin with, it's a listed investment company, unlike a managed fund. So investors are actually shareholders in the AFIC company. They're not unit holders within a fund. And investment decisions that they may make, they can impact the share price, but they can't impact the underlying holdings that Mark and his team manage, which we think is a big differentiation between owning a LIC and a managed fund. We love that you guys are long-term buy and hold investors, which suits the Hewison Private Wealth investment philosophy. Your long-term track record of professional management is unquestionable. And we love the fact that you're an absolute return. So you seek, absolute returns within the portfolio. So you're looking to outperform an index over the long term. You're not looking to hug that index, which would be more of a passive investment strategy sort of thing. So, look, without further ado, I'm going to jump straight into it. So Mark, I'd love to start with you. Just in relation to looking at sort of your portfolio management style. In your September 22 blog on your website titled the full year 20 reporting season proves quality companies can thrive in a crisis, you state that your guiding investment principle has always been that quality companies are attractive long-term investments, and we remain committed to seeking out and holding high quality companies that can lead to the economic recovery. And I'd love to know, what is AFIC's process for seeking these high quality companies?
Okay, no, it's a simple question to start off with. And my understanding is it's got Geoff Driver on the screen, but it's actually Mark Freeman. I'm getting confused as to why Geoff's talking. Yeah, I'm not sure how to fix that either. Not that up to speed with technology, but yeah, look, I guess it's going back to my time. I first started working on these funds actually in 1994 as an employee of JB Weir, when now I'm part of the group, and I sort of worked with Bruce Teal and Ross Barker in those days on the funds. So I've actually been involved for a very long period of time. And I guess two of the things that, two of the thoughts that always got put to me were stick with the quality and back the people. And so there are two elements that I guess get put to you, but as you sort of spend more and more time investing in markets, you understand that concept in a deeper way as time goes on. And so referring back to your observation, we are trying to find what we call quality companies. We do an assessment of every business we look at. We look at a number of factors that we consider that make up a quality business. So most of them are really analysis or tools around, to put it simply, around frameworks similar to sort of Porter models, to try and understand a business that has a moat, a sustainable competitive advantage, a business that we think has a sustainable business model looking into the future. We prefer companies that have more consistent earning streams. We want companies that are run by good people. Financial strength is important, good balance sheet, and they all can get reflected, I guess, in some financial metrics we see in businesses, such as return on capital employed or return on equity, margins, and sort of net debt to EBITDA and interest coverage. So I guess when you fold it back to the financial metrics, finding businesses that produce a higher return on capital, and we take a view that they can continue to invest in that way, i.e. there's a growth runway, they're the sort of businesses you want to find and invest in, and then hold them for the long term. And that gets back to the concept of sort of the compounding effect of holding winners for the long term, and just trying to hold them. And that compounding effect is really one of the concepts that's really misunderstood, I think, by institutional investors who, as soon as they hold a stock that goes up, the first thing they want to do is trim it for portfolio balancing, and you lose all the performance you get from finding a great company and holding onto it. So I guess there's some of the basic frameworks, and I think it's interesting, I guess, referring back to your introduction, going through another reporting season. I usually write a brief note to our investment team about what I've been observing, and the amount of times I write what I've learned from this reporting season is the better quality companies give you better profit results. And I think I've been writing that for years and years and years. It's just a consistent theme that comes out of it. So, we are a long-term buy and holder, but it doesn't mean that we're not looking to constantly improve the quality of our portfolio, because certainly there are some stocks that were in the portfolio. If I think back 5 years ago, that we took a view that we think they have structural headwinds, that their ability to grow earnings over the long term is going to be inhibited, And if we think that about a business, we do need to exit them, and we do need to keep looking for the up and coming companies that we think can grow for the next 10 years or the next 20 years that fit our framework. So we have to make sure that we keep up with the times and not just be stagnant in what we're looking to do. But with the same approach, once we buy them, seek to hold them for the long term. As I said, a lot of that is around getting the compounding impact of good winners, but then also avoiding the turnover, the costs of turnover. We understand tax is a drag on performance. I think retail investors understand that. Institutional investors don't. They don't include the impact of tax in their performance and the performance fees they charge. So they're very active in their turnover, and they kind of leave it to the end investor to worry about the tax. We know tax is an inefficiency, so we try and avoid that. And you avoid that, once again, by finding good quality companies and sticking with them. So that's what we do. And and I think your point about why invest in a listed investment company, I'll make a quick comment on that and then I'll pass it back. We've been around for a long period of time. The shareholders own the company. There is no management business off to the side taking fees. So the shareholders own the business. And so I think the MER on AFIC, Geoff, just quite enough, is probably at 0.14, 0.13%.
0.13 at the moment, that's right, yeah.
And there's no performance fees. And so all the value goes back to the shareholders, essentially. And just sort of one final comment on sort of our returns. The other thing, we will look at our total return over the long term, but we also look at the volatility of our returns. Overall, the time references we look at, we've had a much lower volatility than the market, and we are conscious of trying to, I guess, keep up dividends to our shareholders to the extent we can. We understand that franked dividends are very important part of the total return to our investors. So there's a few other comments. So I'll pass back to you at this point.
Thanks, Mark. Just one final piece of that question, because I know that this is always something of interest to clients and people listening. We'd love an example. Perhaps if you could just give 2 quick examples of, say, a company that you perhaps have decided to either exit or trim back on over the last couple of years, because you mentioned over the last few years that may have been the case, but also any recent acquisitions that because I know, if you look at the top 10 or top 20 odd holdings of the AFIC portfolio, generally it remains pretty steady, although I reckon there's been a couple of new names I've seen in there. Maybe just pick an example as to one that's maybe made it into the top 10, top 20 that you really like.
Yeah. Look, I could mention a couple. I guess there's probably 2 broad buckets we look at for the stocks in our portfolios. We're happy with strong, stable businesses. We're not looking to shoot the lights out with all our stocks. So we sort of call them sort of stalwarty type businesses that we think have that really strong competitive advantage, and we think they can continue to grow over time. So, businesses like Wesfarmers, Woolworths, they're quite, you could argue they're quite mature businesses, but their return on capital is very good. We think they can continue to grow, even if it's a slower, steadier rate. They will get good dividend growth out of them. So we like having some of those stocks. And Transurban, I guess, is another one too. So they're good core businesses that we hold. And then we're looking to, I guess, add to those businesses. And then they provide good yield and stable yield. They're sort of almost like the backbone of the portfolio. And then, we are conscious that we're wanting to grow earnings. So we sort of have had some more developing type businesses or businesses that are just not as big as those that we think have outstanding business opportunities that will be able to grow dividends over time, even though the starting yield might be a little bit lower. And we've seen some of those come up into the portfolio over time. So I guess one of the newer ones to the portfolio has been NextDC. We started buying, I think, in around the mid $6 price. And I guess some of the thesis around that was we're looking for developing companies that starting to exhibit a leadership position in what they do. We wanted to get comfortable that as they filled out a data center, they were going to get an appropriate return on capital. So return on capital is really important because we want to be in companies that invest and create shareholder value from that investment. And that's a really important factor in getting earnings growth over the long term. So we got comfortable with that, and we just think there was a very long runway of growth ahead.
Sure.
From the whole digitization of the world, essentially. And I think one of the important parts of investing is to identify these businesses and get in early.
Okay.
Half the challenge is if you miss something and it goes up, what do you do then? It's another example of a stock that we bought over the last couple of years on a similar basis was Xero. Again, that was a business that was a more developing company, but it was ticking, it had the attributes. You know, I talked to our team about finding companies that have the right attributes or characteristics. That's a really important part of investing because you can have your own sort of personal views on the business, but let's talk about the attributes of a business. And if you looked at Xero when we bought into that, again, I think we bought our first parcel of stock when the share price was around $15. And when you step through the dimensions around that, we like owner-driver businesses. We like businesses that the CEO has been involved with starting the business, or businesses where management have a lot of equity. We think that can deliver outperformance over the long term. So that was an owner-driver business. It was demonstrating a leadership position in their markets. It was exhibiting strong growth. They invest heavily in their products and businesses through R&D, in their case technology, and we thought there was a very long runway of growth, and it was clearly a product that people liked.
Yeah.
So the key to that was to recognise that, hey, this has got all the characteristics we like, apart from it wasn't profitable at the time, but we can have one or two of those in the portfolio if we are comfortable that there's clearly a pathway for them to get into profitability. And what you could show is that in the more mature market in New Zealand, they were very profitable in what they did. So invest early, and we've held on to that. So
sure.
There are a couple of examples. I guess another one, a profitable business that we bought probably 4 or 5 years ago is actually a New Zealand company called Main Freight. And the characteristics around that, and you'll probably start to see a pattern where it was an owner-driver company. The board had a lot of stock. They are, because it's their company in terms of their ownership, they are absolutely all over their business. Strong cultural values, really understand the customer, great track record, strong balance sheet, invest for the long term. And I guess the term, you get the warm and fuzzies when you speak to the CEO, a great sense of trust.
Sure.
And they are a global transport company, competitive industry, but they've got something special there.
Yeah.
And there's so much opportunity for growth. So here's a chance to put money with some people who have demonstrated that they're really good at running a business.
Great.
They provide cultural alignment. They understand customers in this huge market potential. In my view, only one thing was going to happen. We were going to make good money from it. And that's been a great investment for us. So
I'll get it, Mark. I'll keep going on.
Yeah, just quick. AGL's the stock we've exited.
Okay.
Above 20. And that was about structural headwinds.
Okay.
A lot of their profits come from their coal-fired power station. I don't have a problem with the people running it and the like, but when so much of your profit comes from coal-fired power stations and the price was leveraged to the wholesale electricity price, we just thought that there's some long-term structural issues around that. We are a long-term investor, so with headwinds, we got out. Fantastic.
Thank you very much for that. Just moving on a bit of, I suppose, if we could combine a couple of questions, just in relation to AFIC's portfolio exposure versus that of, say, for example, the ASX 200 being the main index here in Australia. Do you take note of your industry exposure versus the makeup of the industry exposure in the index, or are you completely unaware, regarding, if we take an example of fin services, I don't know what the exact percentage is at the moment, but I think it used to be around sort of that 30% mark of financial services, businesses, banks, etc., making that up of the weighting of the index. Is that something that you pay any attention to when you're managing your portfolio?
Well, probably less so on sector exposures. Look, you can't help, if you work in this industry, and not have some sort of eye for what the index weighting is on a stock. It's hard to avoid that. But we've got 60 stocks. It's down quite a bit from what it used to be. That number feels about right to me. When I look through our portfolio, I can see there's probably a couple that might be on the way out, and I can see there's a prospect for a couple more. But no, what we've been trying to do is actually just increasing more and more with the ones that we have the greatest conviction on. Just talking about financials in particular, I think our weighting in the 4 major banks is actually down to about 15.5%. We exited some of our holding a few years ago now, and which is pleasing. But we've kept up some exposure because there's a balancing up for us, because a lot of our shareholders like franked dividends. But we have been underweight the banks for some time now. Probably in hindsight, we probably should have gone more underweight, but it would have impacted our dividend paying capacity at the time. So we've tried to sort of have that balance between businesses that provide income, but make sure we're getting companies into our portfolio we think are going to win over the next 10 years. Because, I think the nature of the market and industry business construct of the index, it's changing.
Well, that's a fantastic segue into my next sort of little grouping of questions here, because they do relate to the banks. And as you've already explained, that AFIC historically have had a large proportion of bank exposure in say the top 10 holdings of your portfolio. But I mean, it's just over the last 10 years, obviously they were, longer now, they were hugely impacted during the GFC, and obviously the Banking Royal Commission didn't help them, and now they've been sort of whacked again throughout COVID. And I mean, look, I'm sure you're aware of this, but I just had a look at one in particular, ANZ. Aside from the GFC, it last traded about $18 in 2002. So if you sort of held that and you didn't trim it, or you didn't pick up more, you haven't made it. Oh, you've got the dividends, of course, which has been very healthy, but it hasn't probably been a great performer for a long-term buy and hold. So why would you say AFIC has traditionally been a big supporter of the banks?
Yeah, look, there's a couple of comments on that. Probably the first one is that we understand the value in franking credits, and if the stock had gone sideways for that period, if you were getting along the way, I'm not sure what the average yield would have been, say 5.5%. It might be a bit higher, maybe it might be a bit lower now, but if you gross that up, that's about 8%.
Yeah.
So if you value franking credits, it's probably still lower than the market, but it hasn't been a disaster as such. And I think that's a powerful thing about franking, is that it's hugely valuable for most investors. So I'd say they haven't been as bad as what they appear on face value, but clearly, they haven't been great. I think probably our thinking has always been that balance between trying to keep up the yield, but apart from, I guess, some of the placements that banks have done, and a lot of those we've actually traded out, we really haven't put new money in the banks for a long, long time.
Right.
And in fact, we've taken money out. And as I said, currently we're only at just over 15%. So it's become a much smaller part of our portfolio. Yes, over time, we've been allocating money into other sectors. So I guess where we think about the banks going from here, we probably still think it's going to be a struggle to get earnings growth. Now, I think the big thing that's changed for me from an investor perspective is that for many, many years, and this probably relied on the sort of gearing up of the Australian household, but they were doing return on equity probably around mid-teens, 15%, 14%. That's a very attractive return. That's a good business to be in. But things have changed. The industries or the market's slowed. There's been a lot of headwinds. They've had to hold more capital.
So what do you think of the future prospects for the banks? I mean, do you keep a close eye on, there's this view, and I'm really interested in your view on this. There is a view, perhaps a bit of an uneducated one, from the armchair investor who says, well, we're ripe for disruption here. There's so many fintechs coming into the market. There's online sort of lenders that are coming on stream, and open banking obviously is going to be something we're right on the edge of. Do you think they're going to be able to defend their turf going forward?
I actually think they'll be able to hold their ground, as it were, but I still think that means they're going to be challenged for growth. I think the capital position is pretty good, so I think they can get back to paying higher dividends than what you've seen, but it is going to be more about an income play, and I think they return it. And I said the return on equity, I think my best guess is that I think the companies are hoping they can get back to 10 to 11. I think one of the analysts I was speaking to the other day was talking more like 9. That's a completely different investment proposition to what they used to do, which is a 15% return on equity. So all of a sudden, in a relative sense, other businesses look more attractive than something that might only give you a 9% ROE. So therefore, I think over time our portfolio will keep, the exposure to banks will keep declining. There'll be a natural decline. As we find businesses that can give us better return on capital, they will become bigger in the portfolio, and the banks probably will shrink. And you can sort of say, well, why don't you sell more? Well, I think they can probably do a bit better on the dividend. So if they can do that, they're potentially in the short term are probably a bit oversold. None of the institutions hold it. So with that dividend yield, so I think it's just going to be a gradual transition for us. And it'll be more as we find better opportunities that you might see a bit more coming out of the banks over time. And as we see other holdings start to lift their dividends to offset what you might lose by reducing the banks. Fantastic.
And you've made a couple of comments there, Mark, about the dividend. So Geoff, I might throw it over to you just quickly. Your record on dividends is absolutely impressive, and it's obviously a large factor into why certain investors choose AFIC as a long-term piece of their portfolio. The dividend did not even, as I read correctly, I believe the dividend didn't even really fall during the GFC. And since 2013, it's grown from 22 cents per share up to 24 cents per share at the moment. Are you confident that dividend will be maintained over the next sort of period of time, 12 months or so?
Yeah, well, let's give you a bit of background first before we go straight into that, answer that question. So I suppose at the end of the day, one of the things I guess investors like about listed investment companies, particularly long-standing ones like AFIC, is that over time they can build up reserves and retain profits. So just stepping back through the GFC, obviously we felt we wanted to maintain the income for our shareholders, and we were able to do that. And what you did see in the market is dividends recover relatively quickly. That allowed us over time to increase that dividend up to where we are now. Last financial year, clearly with the COVID situation, what you saw was, I think our dividend was 24 cents per share, and our earnings were about 20 cents per share. So they really significantly impacted the second half of the year. We understand dividends are really important to our shareholders. So look, I think what we have to do is look on a 6-monthly basis at each time of the results, and to consider one, what level of reserves to use on the dividend, and then secondly, what the outlook for the following year is in terms of. So it's very difficult to give answer on that other than to say we are very conscious dividends are very important for our shareholders. I think you're on mute, Andrew, sorry.
I was getting a bit of feedback there, so I put thanks for that, Geoff. Mark, throwing it back to you, you're talking about the GFC, which, you know, it was a long time ago now, but I guess to many of us and some investors, clients on the line today, still burned and etched into our memories. Do you see many similarities at all in relation perhaps to the way the market has reacted, whether it's overreacted or you know, just in terms of what you're seeing in the market generally between the GFC and what we're seeing in 2020?
No, I don't. I think the events in terms of, I mean, you can talk about the events that caused the market to fall, but at the end of the day, it was a fall in the market. Whatever precipitated that. What we did see, though, is the same theme playing it out that we have with every other event. The market fell dramatically, very quickly, and for long-term investors, it was a buying opportunity. And it's one of the rare opportunities you get to actually buy the high-quality companies in the market, because they got sold us savagely, but they recovered very quickly. So, you know, I tend to think about, you know, investing in the share market. You seek out these large dislocations in markets and you buy. And if that's all you ever did, don't worry about why it fell. You just buy the fall. Yeah. And the key part is that at the end of the day, you're buying assets. These are called shares, and they were selling at a price that was way cheaper than what they were. Don't worry about why it was happening. It was a buying opportunity, and we talked about that back. We did an update back in March during the fall. I sort of made the comment that, you know, if you refer to history would say there's probably going to be a buying opportunity. So we did that, and we actually used it as a chance to get more of the quality companies and then exit the ones we thought were lower quality. The key was, you know, always you hear the term, don't waste a good crisis. And the theme to the investment team was to make sure that when we recover from this, we look back and say, gee, our portfolio is much stronger than what it was pre the downturn. So that's what we did. We tried to take advantage of it. And you look back and say, wish we'd done more. So that's always going to be the case, isn't it? So
I've just written that down and underlined it. Don't waste a good crisis. I think that's a rather good lesson.
Yeah.
You know, there's obviously, as we speak right now, there's a presidential debate going on between Trump and Biden. And there's so many other, you know, I mean, there's so many other macroeconomic issues that can arise through, whether it's predictions or things that can happen unexpectedly. Does the AFIC Investment Committee, I'm not suggesting you're going to be worrying too much about who wins the presidential election, but I mean, you know, back here in Australia, if there was an election, you know, coming up or something along those lines, do you get too involved in the macro analysis, or are you very much sort of a bottom up sort of micro, you know, kind of manager of the portfolio?
We're bottom up. We're just trying to find good companies and putting our money alongside good businesses and people running good business, and let them worry about trying to manage the macro environment, because they are far better at it than I would be. I'm trying to pick a macro trend. I'm no good at that. So don't ask me about the currency. I wouldn't have a clue. What a market's going to do post the election, I've got no idea. People had all sorts of theories when Trump got into power. I think the markets went down a little bit, then they went flying high. So, and a lot of the relationship about how the market might perform post an election, I actually think the biggest factor that determines that is where the market is positioned. You get a high point in terms of valuation or a low point in terms of valuation. A lot of people sort of try and say, well, the market responded because so-and-so won, and you look back and sort of say, well, no, the market actually went up because it was cheap at that point, not because of elections. So, no, macros are very, very difficult to predict. Markets are very difficult to predict. We just try and stay fully invested in good companies. I mean, you've got to try and work out what you think you can actually, what you're good at and what you're not.
Yeah.
I can't predict those things. All we can do is trying to find businesses that have the right characteristics that we think our experience says will lead most likely to a good long-term investment, getting those companies and then just leave it. Trying to pick when to have cash and when not to have, I don't know, it's too hard for me.
Yeah, no, well, someone who we all know of reasonably well is Warren Buffett, and I think he tried to, for the first time in his career, tried to make a macroeconomic call in relation to interest rates some years ago, and the only time he tried it, he got it wrong. So I don't think he's done it again either. I appreciate that honesty on that question as well. I guess speaking, in relation to the market to some degree, and in some ways you've already answered it, but maybe we can go down a bit deeper. I guess you could say the COVID pandemic has been somewhat of a macro issue. So I'm guessing you probably haven't really made any fundamental philosophical changes to the way that you would invest on the back of COVID, other than, to your point, taking the opportunities when you saw them earlier in the year. Would you agree with that statement?
Yeah, probably. It just reinforces our approach to investing, because the good quality companies have come through this in a much better way. Apart from, obviously, there are select stocks and sectors that have been directly impacted. Now, we have Sydney Airport. We'll continue to hold that because we think through every sort of SARS and all sorts of issues, the flying the planes into the Twin Towers and all that, the disruptions were, from our investing time frame, were short term. And we expect travel will ultimately come back and they're good assets. And in fact, we participated in the capital raising. I think in the fullness of time, you look back and say, actually, that was a good buying opportunity. We put more on the Auckland Airport. We built up our Auckland Airport holding during this period. But they've been directly impacted. So clearly their profits are under huge pressure. But if you ever look through the Australian market, I mean, a lot of our stocks, they haven't really been significantly impacted. I mean, the banks have suffered. I mean, they're in the portfolio, but a number of other stocks, the things like CSL, Fish and Paykel Healthcare, which we think is a great company, ResMed, Sonic, they've been fine. And in fact, a lot of our companies we think will come out of this with a stronger competitive advantage. That's one of the things you look for. So, I think the real issue which is the sad part and probably the bit, and so we have investments in Brambles and Amcor, Wesfarmers, as I mentioned. These are Macquarie Group, big global companies. Most of the pain is actually in SME land, small businesses, and I think that's where the focus has to be on, because big companies adjust, and that's why our share market's held up better, because there are many companies that are really global businesses that have held up much better. So it's the small businesses that have really been hit hard on that front.
Yeah, sure. Fantastic. I've got one or two more questions, but I would encourage anyone who's on the line today that has got a question, jump into the Q&A box down at the bottom of the screen and ask a question of Mark or Geoff, and I will follow that through. I just was curious to get a view from you, perhaps both of you, or of AFIC being Australia's largest LIC structure, but also the fact that you are, at the helm of Djerriwarrh, Mirrabooka and AMCIL, which are, some of them are, smaller. Just any thoughts on the future of the listed investment company structure, that versus the the listed investment trust or an ETF type of structure. You know, there have been some more recent listings of listed investment companies onto the market, which clearly perhaps are just not big enough and are traded very thinly to a point where they're trading at significant discounts, and it seems very hard for them to get off the ground. And there's been, I guess, somewhat of, I don't know whether you call it criticism of the structure, but it just, you know, the criticism of the structure of these particular investments is that they are trading at significant discounts. Do you guys have a view on that at all?
Yeah, I'll just make one comment, then I'll pass over to Geoff, is that I guess a lot of these newer LICs that have come onto the market, one of the things I would really focus on, though, is the fee structure. Okay, we all might be listed investment companies, but that's the first thing I would look at. And I guess, you know, pointing out again, at AFIC, 0.13% no performance fees. I think some of these other newer LICs that have come into the market are high fees, performance fees. And I guess that's something to think about. And the other thing is just the portfolio turnover and the potential to sort of pay a lot of tax on that basis is another factor. So, well, you know, we actually see them quite different to what we do, even though they're all LICs. So, yeah, that's probably a key consideration. But Geoff?
Yeah, so it's a bit of a vexed question in some ways, because I mean, the LIC structure is good from a manager's perspective, in the sense that you have a set pool of capital you can deal with, and you're not sort of your investment's not thrown out by the fact that it inflows now funds. So that's clearly why some of these fund managers have decided to launch LICs. The other thing from their perspective, obviously, is the permanency of capital, which they can set against very high fees, which from their perspective is beneficial to them. I think what you're saying is right, Andrew. I think some of them have come to the market, they're way too small. They don't necessarily have the dividend policy that some investors are looking for. And I think LIC investors particularly want either consistency or fully franked dividends. I mean, some of the new LICs haven't even paid dividends, I don't think. So in terms of attracting a certain shareholder, I don't think they've quite been able to develop that sort of value proposition for investors. And I think the other thing they've trapped to fall into is that they're buybacks to close the discounts. And what that basically does is just shrink yourself to oblivion in a sense, because you're just basically reducing liquidity in the market. And so I think that a lot of the smaller ones are in very difficult, and I don't know how they're going to close those gaps. I think some of them are applying a more innovative approach in terms of offering buybacks of certain percentage of funds to close to NTA now. So that's what they're looking to do. But I think the issue of size is something that's going to be very difficult for them. I think the structure is still good as compared with a listed investment trust, for example, if you run it properly. But I think some of them have got into a space they're not exactly sure how to operate within.
Yeah, sure. I appreciate that. I've just got a question pop up here from John Hewison. John has asked if AFIC have a view around the recent controversy around placement fees attached to some of these recent listed investment company listings. And just if there's would you like to explain, do you see a distinction between a placement / stamping fee versus a sub underwriting fee? Or do you
I think there is a difference.
Okay.
Look,
explain that to the group.
I think, I mean, what we're talking about here is basically financial advisors or planners getting paid by the company to market or place the shares with their clients, obviously. I think in some ways it's a little bit different than what the controversy was around trailing commissions and those sorts of things. It basically using people to to do a bit of work for them to place the stock if they think it's appropriate. I think the problem has become some of those fees became very large. So clearly that sort of brings into question the fact, well, is it in fact an appropriate level of fee being paid to advise a client, and self-interest potentially could come into it. I think an underwriting fee, I should also say we really haven't used placement fees. We don't, that's the sort of thing we do. We don't do we did stamping fees once with a convertible note, but I think that was about 1% at that time. I think in terms of underwriting, I think that's a lot more work for a broker at the end of the day. So they probably do deserve some sort of fee associated with doing that, particularly if they take on some of the risk at the end of the day. In terms of the change, we're not fussed by it if that's what is happening now in the market, and there's no more stamping fees. It's not going to impact us, but I think it's going to impact potentially some of the other LICs we talked about earlier on.
Yeah, sure. Well, gents, there's no more questions that are popping up, so I'm not sure if anyone has any last-minute questions to answer, but to ask. But I suppose whilst some people might be making their final decision, I think I just wrapping up on the conversation, which has been absolutely sensational. It's, for all the years that Hewison Private Wealth have been recommending Australian Foundation Investment Company to our clients, it's the first time we've had the privilege of having you both on the line to talk in some detail of the philosophies and how they've evolved over time. And one of the couple of things that really left a mark on me was, just Mark, when you mentioned the performance of AFIC, which has been absolutely sensational over a very long period of time. But to your point, it's not just about performance, it's also about volatility. And I think that's really important for our clients to understand as well, because whilst return is important, in some respects, it's equally as important to protect capital. And obviously through a portfolio that, and sometimes we explain it to our clients by saying, look, an investment in Australian Foundation, it's not always going to perform at the same level as the market during a bull market, but you're going to see it's going to protect the downside during a bear market more so than perhaps what you'll see, in the market with peaks and troughs and so forth. So that was a really important point. I loved hearing you talk about the importance of backing the people in a business, which in some respects makes your investment process extremely, unique. I'm not saying you're the only ones, but it is unique. That, and to your point around Main Freight, as an example, going in there and investing in a business that where it's been built from the ground up and the owners are still in it and can talk to you about the culture of a business, etc. Very, very insightful there. And of course, your statement around don't waste a good. If you're a long-term investor, don't get too concerned by a crisis. Just don't waste a good one. So, some fantastic takeaways there. But I'm not seeing any other questions, Mark and Geoff. So I guess we'll draw a close. And thank you so much again for joining us today. And perhaps in the next couple of years, we might grab you back for another update, which I'm sure the clients would really appreciate it. But appreciate
what, the next crisis, or
I'll see you in 20 years then.
Yeah, okay, good on you.
All right. Well, thanks again for your time, guys. Appreciate it.
Thanks, Andrew. Thanks, everyone. Thank you.
Bye-bye.